Welcome back to In Your Money. We're discussing investments this evening. My guest is Henry Biddlecombe. And if you want to email, you can always send your emails. My details will appear on the screen. Got the first email this evening from Mervyn in Belita. He says, what are your views about investing in bonds for both high interest rates, and then he says, and some capital appreciation when interest rates fall? Interesting one, Henry.
Yeah, it's an interesting one, and it's exactly in line with my current thinking. I think the long end of the curve, so in other words, higher duration bonds, sort of in that 20 to 30 year plus category, are looking very attractive right now. So if you look at the US 20 to US 30 year, you're earning anything from 4.5% to 5% a year in a coupon, and I do think that longer dated rates are due to come down over the next 2 or 3 years. So you'll benefit from capital appreciation when that happens, if that happens.
Yeah. Caroline in Henlops River says, my father, who recently passed away, had a portfolio made up of predominantly of gold shares. I only wish he was here to see his dream come true. There's growing talk that gold could reach $4,000 per ounce by the end of next year. What are the main factors driving the gold price, and what is your view of still holding on to these shares?
So answering that backwards, I think the factors driving the gold price right now are predominantly the debasement of the dollar. So, the dollar expressed in gold has gone backwards. That's driven the gold price up, because it's a price that's denominated in dollars after all. You've also got a lot of global uncertainty, very high levels of inflation, and that's positive for gold. So that would mean that this gentleman's portfolio has done very well for the first couple of months of this year. I've talked about a gold price
compared to the previous few years.
Compared to the previous few years. Yeah, many years. You're talking about a target price of $4,000 on gold. I've seen strategy notes come across my desk calling gold to $5,000. And they could be right. It's very plausible. But when you go back to concentration risk, having too many eggs in one basket is never a good thing. Tail risk is very real. And if it is a massive proportion of your portfolio, I really beg you to start trimming now. The first half of the year has been good to you. Take profits progressively, work with a financial advisor. I mean, I don't have sight of the numbers, obviously, but it sounds like you might have more than 50% of your portfolio in those shares. Trim that. Take that down to 20 or 25% now.
Yeah. Marcus in White River says, I'd be interested to know how you pick a company to invest in and what factors do you look at?
Yeah, so it's always tricky to answer that question. Every fund manager has their own style. But a principle that's done very well for us through time is just investing in companies that earn a very high return on capital. Companies who can reinvest their profits and earn a very high return on capital. So a very high return on incremental capital invested. And just qualitatively, companies that have done well in the past, that have deep competitive moats, good, strong franchises. Those kind of basic principles will serve you well. I think the deep value guys struggle. I think they go through long, protracted periods of underperformance, and then they have a purple streak, and it's very difficult to call the top. So just stick to quality. You've got a better chance of getting it right.
Henry, let me add to that. How do you've got a menu, you've got a certain amount of shares you look at. How do you often deviate to actually have a look at a smaller company that's now developing and growing its business? How do you actually find those type of companies?
So the first thing is, remember, smaller companies don't always perform better. The best return to be had in markets over the last 10 years has come from who? The biggest companies in the world. So don't be afraid of investing in already large companies. Sometimes you can make the most money there. But small companies can also do well, although they're more difficult to find. But Bryan, what we do is, we'll decide on the qualitative and quantitative factors that we prioritize. That'll give us an investment universe. So we'll filter the market down from, call it 5,000 shares globally to a couple of hundred. We'll analyze those stocks and come up with a portfolio of 20 to 30 stocks. And then every year we cast the net wide out once again to see if any new stocks have entered that kind of more narrow investment universe. And that's the process that we follow.
And often that means you'll miss that first uptick in those particular stocks.
Oh, yeah. You always miss more than you pick, by definition.
Yeah. Then Barry in Mshlanga says, and we've dealt with this, but he just says, if the United States records negative GDP growth in the next quarter, does that mean the country is in a recession? And how would this impact on global markets?
Yeah, so again, the headline on the day, it would, and the headline on the day would probably be bad, and the markets would probably trade down a couple of points. But again, the market isn't sitting there waiting to see what the growth next quarter means for the next 10 years. That's really just noise. I think that the US economy is under pressure. It's been under pressure for a while. And again, what's more important is, what is that reality in relation to the valuations we're seeing in the market? I think the market's run ahead of itself, so I would dial my risk back.
Okay. Then Trevor in Hout Bay says, I understand that South Africa is likely to be removed from the grey list by October, and we've discussed that. However, two key actions remain outstanding: the prosecution of serious complex money laundering cases and prosecutions covering the full range of terrorist financing offences. Given the extent of corruption in South Africa, doesn't that have to first be realised and have an impact?
Yeah, I guess it does. I mean, I must be honest with you, I'm not at the cutting edge of what's happening there. So I can't tell you how much progress we are or aren't making on that exact front. A lot of what we read in the news and what happens on that front in South Africa continues to be disappointing. But that's just, I think, two very small problems amidst, a set of much bigger problems.
And then just to answer Brett in Hyde Park's question, he says, what are the main risks facing global markets, and do you believe emerging market equities still offer better value? I think you've touched on that.
Yeah, I mean, look, great question. Is EM a good trade relative to DM right now? Yeah, I think it is. If you go and graph that as a pair through time, the jaws have probably opened up quite a lot. So that might not be a bad tweak to your portfolio. What are the biggest risks to the market right now? Sure, I think geopolitical relations right now between the States and their competitors in the East. Big things can happen, and they can set markets off. And like I said, at a point where valuations are extended. So if we were at 5,000 points on the S&P 500, for example, I'd say don't worry about it. There's a little bit of uncertainty priced in. At 6,000 points on the S&P, no uncertainty is priced in. So the reaction to bad news will be pronounced.
Yeah. And then, Henry, let's just talk a little bit about BRICS, because, South Africa is now part of BRICS. There are 11 countries in the BRICS. But the BRICS don't seem, with all this problem between South Africa and the United States and what's happening and the possibility of AGOA coming to an end, none of the BRICS seemed to be getting involved and giving any suggestions to South Africa. We'll pick up some of the slack. I mean, is BRICS really just a club? Or is it, how do you feel that BRICS play a role in helping South Africa in any way?
Sure. Difficult question to answer. Yeah, I don't think they can. I think, each one of the member states kind of has their own set of problems. And at the end of the day, if we're talking about our relationship with the states, each one of those countries has their own relationship with its own kind of factors. So we need to look after ourselves, and only we can look after ourselves. Our mates can only help us to a limited extent.
Yeah, but there's been very little comments made by BRIC countries about, don't worry, South Africa, we'll pick up some of the slack, that type of thing. There doesn't seem to be any real business relationship other than a trading club.
Well, if you, if the states, and I suppose specifically Trump and his team, see one of the other countries standing up for us, they'll be the next target, won't they? So perhaps they don't want to pick their heads up too high at the moment.
Did you, obviously just a question, a personal view, how did you feel that South Africa held itself up in that meeting in the White House?
Look, I think it was maybe a little bit clumsy and chaotic and disjointed, and all the things that need to be said on a global stage so badly weren't said. I think there was a lot of kind of pussyfooting around the real issues. So I felt it was a little bit awkward, and perhaps a little bit of a wasted opportunity, really. But there's what we think and the reality of it. I'm sure that bringing that together is tough. You've got so many different things that you're dealing with, so many different factors, competing factions, competing agendas. I mean, the situation in itself was so pressurized. We've got the press around you, some of the most powerful figures in a room. It's a really difficult set of factors for you to have in kind of the perfect ideal conversation. So I don't want to be overly critical because it's hard to get right.
Yeah, I must say, I also felt, I thought Ramaphosa did handle himself as best as he could. We got a bit ambushed, but we haven't heard too much about where that's developing and how that's going. Well, Henry, we've come to the end of our program, so I'm sorry, Tim, I haven't been able to take your email. I will get back to you personally. But most investors are feeling confused, as most financial programs, radio reports and publications tend to focus on global negatives and the potential impact on our markets. However, long-term investing in quality companies is not your enemy. The real challenges investing are firstly beating inflation and ensuring that your money lasts, especially as people are living that much longer. Many investors also believe that as they age, they must shift to a more conservative investment strategy. But before doing so, you need to answer an important question. Are you primarily concerned about future income, or is it your capital ultimately intended to be passed on to your children? If your priority is income, then it may be time to reassess your growth strategy. But if you have sufficient income and your capital will be inherited by your children, then staying invested for long-term growth remains essential. I'd be very interested to hear your thoughts. Please feel free to send me messages via www.bhca.co.za. Henry, thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program will be once again dealing with healthcare, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.